Okay, well, hello everybody. My name is Paul Miller from Bethnal Green Ventures, and I am delighted today to introduce Sir Ronald Cohen. And we're here to talk about his new book, which I've got here, Impact, which I think is a fantastic book, a brilliant introduction to what's going on in impact investing at the moment. And Sir Ronald is the best person to write about it, I think, in terms of his just deep involvement in the impact investment movement since its beginnings, and just really well connected and influential in this world. So it's real pleasure to talk to you, Ronnie. Thanks so much for joining us.
Pleasure to be here with you, Paul.
Oh, thank you. So I thought I'd start off actually just going back to how you got into impact investment, because it didn't exist. You had to sort of help invent it, as it were. What was the moment where it really clicked for you that there was this opportunity in impact investment?
So sometimes things happen out of the blue. And in this case, I got a phone call from the Treasury early in 2000 when I was still running APAC, asking me to look at the issue of poverty in a more entrepreneurial way. And it's the work of the Social Investment Task Force, which led me to understand that we'd been very imaginative about bringing money to those who want to make money through venture capital and so on. But we hadn't done anything to bring investment to those who want to improve the lives of people. And that really set me on the path to impact investment, and now, as the book explains, impact economies and impact capitalism.
Yeah, and I love the way that you introduce impact investment in the book, in terms of, I think particularly that comparison you make to sort of the introduction of risk as a way of thinking about investment, and that impact may well be a new dimension, if you like, of considering investments. Can you talk a little bit about that framework that you introduced there?
Yeah, I mean, I highlight in the book the fact that for centuries, investors made decisions that were based on financial return. And it's only in the middle of the last century that academics at the University of Chicago, Markovits and others, began to measure risk, looking backwards at the volatility of a stock or of its share price or of a bond. And this opened the door to completely new ways of investing, because the concept of risk-adjusted returns brought in its wake the concept of diversification, the inclusion of asset classes that deliver better return, but are considered to be riskier, like venture capital, investment in emerging markets, which funded globalization. Of course, venture capital famously participated in the tech revolution. And now we're shifting from risk-return to risk-return impact, where investors are showing through $30 to $40 trillion now that are going to ESG investing and impact investing, that they want to achieve impact as well as profit.
And you know, this is relatively new. I mean, the idea of impact investing is, you know, it's certainly only in the last couple of years that I think it's received any mainstream coverage in some ways. But what have been the key developments behind the scenes over the last 20 years? So, you know, since the year 2000, what have been the pieces that have really, you know, got us to where we are now?
So I think there have been two parallel movements, if you like. There's been a popular movement which has to do with the changing values of young people in particular, who began to refuse to buy the products of companies whose values they didn't share because they were using child labor or they were heavily polluting the atmosphere or whatever. They were also refusing to work for certain types of companies. And I think investors became aware of this and began to realize that this would have implications for the returns of their portfolios. Some of them were also motivated in the same way, to try to make investments that do good as well as doing well. And then you had the parallel effort from the impact movement proper, which was around working out how you can measure impact in such a way that you can actually optimize risk-return impact. Now, for me, impact investment started with the first impact bond in 2010, because that was the first time the Peterborough bond, as it came to be called, because it dealt, as you know, with prisoners leaving Peterborough jail and trying to reduce the number that went back to jail. That was the first time we had a security where the return depended on how many prisoners actually avoided going back to jail. So you had a financial return that depended on the social good. So putting it differently, you are optimizing risk, return, and impact. And since then, we've seen private equity funds, venture capital funds begin to apply impact measures to their portfolio companies. You do that, Bridges Ventures, Avishkar Ventures, Leapfrog Ventures, now even big private equity funds like TPG focus on measuring the impact of portfolio companies and reporting on them alongside progress on their profit performance. And so what we find today is that the tools at our disposal for measuring the impact of companies, the tools of technology and big data essentially, do make it possible for us to measure as dependably or more dependably than we measure risk, the impact of companies. And so one of the groundbreaking ventures I've been involved with is a non-profit one at Harvard Business School, which I chair, called the Impact Weighted Accounts Initiative, which basically measures the product impact, the operational impact, and the employment impact of companies on people and planet, and then adds or deducts the combination of all these positive and negative impacts from the bottom line of companies. Yep. So we've reached the stage now where impact investment is potentially $40 trillion of ESG money, which begins to use impact transparency in making its decisions.
Yeah, and there's some big players in that world in terms of, you talk in the book about the pension funds and the insurance companies. And what's your sense of how far along they are on this journey? Is it already happening, or is it still, on the edges, or have we got, it feels like we've still got a long way to go, but I'm just interested in your sense of the momentum at the moment.
As happened with venture capital and private equity, there are some thought leaders. In this case, the thought leaders have been in the asset management business. So BlackRock, famously, Larry Fink's letter a couple of years ago was a sort of wake-up call for the whole investment management industry about the importance of impact. We see pension funds who manage $38 trillion as a major lever in making this happen. And if you survey pension funds, you find some in every country that are on this sort of wavelength. So PGGM in Holland and APG in Holland are two huge multi-$100 billion funds, which have impact allocations and focus on ESG as well. In the United States, you have the largest funds, CalPERS, CalSTRS, New York State, also being interested in that. And in the UK, in Australia, even in continental Europe, which sometimes lags in financial innovation. You're seeing France leading the way with 90-10 pension funds, where 10% goes into impact investment and ESG. But it's early days. It's certainly not mainstream yet, in the same way that it took some years for venture capital to become mainstream.
Yeah. I want to talk a little bit about, in some ways your two careers and where they might come together. I mean, you started out in venture capital, really bringing venture capital to Europe, and obviously backed some incredible technology companies. And then there's the impact world. And I wonder what your reflections on where the two might come together. I mean, we call this tech for good at Bethnal Green Ventures, but I guess, what do you think is the opportunity for technology in the impact world? And also, I guess, is there other things that impact investment could bring for the technology world?
So as you know from reading the book, Paul, I compare the tech revolution and the impact revolution and come to the conclusion that they're very similar in that they are both hugely disruptive of existing business models. Tech has become the water on which every ship must sail today. You can't have a venture that doesn't take tech into account in its model. And I think impact is going to do the same. And I think the confluence of tech and impact is not accidental. Tech makes impact investment possible in the first place, because it's only through tech that we can measure and compare the contribution of companies to the environment or to diversity and so on. So at the basic level, it's the tools that technology brings us that enable us to achieve impact transparency similar to transparency on profit and on risk. But in another way, through impact entrepreneurship, which of course you're very much involved in, tech brings new ways of optimizing risk, return, and impact. Tesla would be a good example of a company whose mission was not just to make money, but to achieve a change in the environmental pollution that a combustion engine creates. It proved that you can build a company that is, one of the most valuable in the whole of the field, which also changes the behavior of the whole of the field, disrupts the business model of the automobile industry internationally. And we're beginning to see ventures of that kind. So I'd like to give you an example of why I think risk, return, and impact in the technology area will deliver even better returns than just risk return. Mm-hmm. And the example I'd like to take is in the deep AI area, a company called Orcam in Israel, which decided to, after having a very successful exit in a company called Mobileye, which sold out for $15 billion to Intel, decided to create ways of helping the blind to see, in inverted commas. So it created a device that hangs on the side of your spectacles and whispers into your ear the page of the book you're reading and the banknote in your hand and so on and so forth. And this venture helps 35 million blind people and 250 million visually impaired people potentially. But if you bring impact into play, you ask yourself the question, how can this advanced technology help the maximum number of people on the planet? And the answer is a surprising one, because the answer is, well, what if you gave this device to the 800 million illiterate adults in the world? What would that do for their lives, for their economies, for the world economy? And so you can see that tech for good, if you seek out the impact and measure it, is capable of serving underserved populations, huge underserved populations, something that we couldn't do without tech.
Yeah, and in the book you talk about the real scale of it in terms of this impact unicorn idea. A unicorn in the tech world is there's a company that's valued over $1 billion, but you talk about it being valued over $1 billion, but also serving 1 billion people. I mean, is that something that you think? I mean, there are a few examples of that, perhaps Tesla and so on, but is that something you think we'll see more of?
I can see that on the horizon, in the same way that in the early days of Apple and Microsoft, you knew that something huge was afoot. And it's taken 25, 30 years for these companies. Amazon floated in 1997, unbelievably, to make it to the biggest and most valuable companies in the world. And I think we're going to find the same with impact. What we need, though, Paul, is we need to have this transparency on the impact that companies create. And if you go to the Harvard Business School initiative, I was talking about the Impact Weighted Accounts initiative, you will see the accounts of 1,800 companies, and you will actually see in the data set the environmental costs, but the accounts exist behind that, created by these 1,800 companies. And you begin to realize that the variation in impact performance, even within the same sector, is absolutely massive.
Yeah.
And so we want to create a race to the top, but we've done this analysis on the basis of public information. And we need accurate information from companies, completely accurate information from companies. It needs to be audited, and we need governments to mandate that companies do provide impact-weighted financial accounts starting, 2 years from now. I make a parallel with 1929, when after the crash, investors realized they hadn't had transparency on the profit companies made, because each company could pick its own accounting policies and there were no auditors to verify them. And today we have a similar crossroad with regard to impact transparency. With $40 trillion going to achieve impact, we have the right to know what impact companies are creating.
Yeah. And I guess that comes to partly my next question around entrepreneurs and how they should address this opportunity. I mean, certainly we come across hundreds of entrepreneurs each year who want to become an impact unicorn, if you like, who want to have that massive impact at scale. I mean, it sounds like that transparency piece is part of it, but what advice would you give to entrepreneurs who are trying to build impact businesses at the moment?
So, I mean, the advice I gave in my book on entrepreneurship, The Second Bounce of the Ball, is start young, think big, and stick with it. Mm-hmm. I would add to that for impact entrepreneurs, find a big problem you want to help to solve. You have to think at scale. You have to be ambitious. You're ready to start much earlier than you think you are, typically. As you know, I started in my mid-20s. By your late 20s, you're ready to be an entrepreneur. You can't learn to swim by doing exercises on the beach. You do have to dive in. So that the basic advice around entrepreneurship holds. But then, like the example of Ocam, pick a population that you want to help and find a way of building a massive company, massively profitable, whose profitability increases as you help an increasing number of people.
Mm-hmm. And do you think it's different in different parts of the world, or is this advice universal at the moment? Is it something that could come from anywhere, or are there particular hotspots, if you like, for impact entrepreneurship?
Well, that's a very good question, Paul, because I think one of the big differences between the two revolutions, the tech revolution and the impact revolution, is that the tech revolution ended up being concentrated in Silicon Valley and a couple of other places across the world. But you didn't find amazing tech entrepreneurs in great numbers outside these locations. The other locations are, Israel, China, and some corridors in Europe. you know, the Oxford, Cambridge, London corridor being an example. I think with impact, it's going to be different because access to the technology exists across the whole planet. And there will be impact entrepreneurs wherever there are talented people who share your and my ambitions to improve the world, and where there are social issues to solve. So I think it's going to be a lot more widespread entrepreneurship. Impact entrepreneurship is going to be a lot more widespread than tech entrepreneurship turned out to be.
That's really interesting. And investors who are getting interested in this, who, I mean, particularly on the tech side, I guess, but you know, impact investment more widely. I mean, what advice would you have for investors who are starting to get interested in impact? Where should they start, other than obviously buying your book and reading it, because that is a great starting point. But where would you point them to, and what advice would you have for them?
Well, I think we've seen the asset management world react because of client pressure. And so my advice would be ask your broker or your investment manager, the manager managing the pension fund to which you make contributions and probably of whose portfolio you're completely unaware. Put pressure on them to tell you what they're doing with regard to environmental, social, and governance investing and impact investing. Ask for your portfolio to exclude tobacco stocks, defense stocks, gambling stocks, you know, and any other stocks that don't agree with your values, stocks of companies that are polluting the atmosphere. If you continue to want to invest in fossil fuels, then in making your decision about it, take into account the fact that ExxonMobil, as the Harvard Business School data set shows, creates $39 billion a year of environmental damage through its operations alone, without the use to which the oil that gets out of the ground is put. That compares with BP delivering $8 billion of environmental damage a year, and Shell, you know, 13 billion. So become aware of the environmental and social impacts of the companies in which you invest, and try to invest in those that are doing good in some way, and avoid those that are doing harm. Then I think there are new categories within venture capital, within private equity, within property, within infrastructure, of impact funds like yours, that have a dual purpose, to deliver market rates of returns while delivering positive impact. And finally, there are new categories like social impact bonds that deliver very attractive risk-adjusted returns. You can make 5 to 10% net on a social impact bond, and your return depends on success in delivering a social improvement in number of children dropping out of school, or number of homeless people who are housed and get into jobs, or number of pre-diabetic patients who don't become diabetic. There are 15 different social issues covered by a couple of hundred impact bonds of one kind or another. And over the next few years, we will see an increasing number of ESG tracker funds. So if you're investing in trackers in this country or in the United States, go for these trackers rather than the ones that include the wrong sorts of companies. But I would say more broadly, Paul, that each of us has a role to play in this impact revolution. As a consumer, let's only buy the products of companies that are doing good. Increasing amounts of information are going to be available. I mean, we will now begin, now that the Harvard Business School effort has opened the way to it, we will now begin to see impact-weighted accounts of companies. become aware of those, and avoid purchasing the products of those that pollute.
Yeah.
And for people of your generation, work for companies that are delivering good. Don't work for companies that are delivering harm.
Yeah, no, I mean, we certainly see that with, our portfolio companies do very well at hiring, I think, because they're so mission oriented, and that's very attractive to people who want to work for them. And finally, can I ask you to do a bit of crystal ball gazing, if you like? So, where will we be with tech for good and impact investing in about, let's say, 10 years time? Where do you think we'll be?
I think within 10 years, the majority of investment will be impact related. Public company investment, bond investments, private equity, venture capital, property, the majority in each of these categories will be impact related. It's going to take us time to perfect the impact accounting system. It took us 9 decades to get to the financial accounting system we have, which was introduced in 1933 after the crash of 1929, as we were saying. It'll take us less time to do it because we already have the model of financial accounting to lean on. But I think in the same way that venture capital helped us on the path of technology disrupting all business models, impact investing is putting us on the path to disrupting all business models, and it's going to happen quickly.
That's great. Well, thank you very, very much, Ronnie, and thank you immensely for writing the book, because I think it is such a useful artifact and piece of work for the impact investing and the tech for good movement. So thank you so much for talking to us today, and thank you once again for writing the book.
Great pleasure, Paul. And as you know, all the royalties of the book are going to impact charities. I think it's the best way for us to spread the word about our movement. And thank you for finding the time to read it and for your wonderful reaction to it.
Thanks. Cheers.
All the best. Bye-bye.